Welcome to This Explainer. Today, we're going to completely flip the script on how you view your mortgage. If you're like most folks, you probably think of your home loan as this simple, two-way street between you and one giant institution. But the reality? Well, it's far more fascinating and honestly a whole lot more complex. We're going to introduce you to the true ensemble cast behind your loan and show you exactly why understanding every single character in this cast is the absolute key to protecting your property rights.
Okay, let's just dive right in. I want to start with a quote straight from our source material that might actually blow your mind. Here it is. The company sending statements may not be the owner of the loan. Just let that sink in for a second. The entity you interact with every single month, the one whose logo is stamped right there at the top of your bill, might not actually own your debt. They might just be a hired hand. Crazy, right?
So the next time you look at that piece of mail, really ask yourself, who actually sent this? Because I promise you, it's probably not who you think. Behind that single piece of paper is this massive, interconnected legal web of lenders, servicers, investors, trustees, and nominees. It's like a giant puzzle. And if you don't know who is who, you really don't know who holds the ultimate power over your home. To untangle this web, we're going to take a quick behind-the-scenes tour through 5 distinct acts. 1. Stop saying the bank. 2. Lenders versus servicers. 3. Investors, owners, and MERS. 4. Trustees and foreclosure enforcers. And 5. Map your mortgage players.
So, Act 1. Stop saying the bank. Role separation. Let's get into it. The very first rule of serious mortgage analysis is role separation. To do this, we literally have to retire a super common, but frankly lazy phrase from our vocabulary, the bank. Look, collapsing everyone into the bank totally strips away the distinct authorities, the specific duties, and the legal limits of the actual players involved. Over the life of your loan, one company might originate it, another services it, a totally different one owns it, another pops up in the county land records, and yet another entity entirely might file a foreclosure. If you lump all of these unique entities into one vague bucket, you lose the precision you need to ask the right legal questions. And precision absolutely matters here, because each party operates under very different legal evidence requirements.
Moving on to Act 2. Lenders versus servicers. These are our front-of-house characters. Let's take a look at who you actually interact with day to day. Say, ABC Lending is your lender. They extended the credit, right? Their name is right there on the original promissory note and the closing docs. But then you have National Home Servicing, LLC. They're your servicer. They are the ones actually managing your account, cashing your monthly checks, and handling customer service under federal rules like Regulation X. The lender is your starting point, for sure, but they rarely stay the party managing your loan forever. Why? Because loans get sold and servicing rates get transferred all the time. And because of all this handoff business, a lot of myths pop up. People automatically think the company sending the statement owns the loan. Or even more dangerously, they realize the servicer isn't the original lender, and they assume, hey, I owe them nothing. But here's the reality check. Just because the servicer didn't loan you the money in the first place, that doesn't mean your debt is magically erased. They have absolute, rock-solid legal authority to collect and process those payments on behalf of the actual owner. This is exactly how the Consumer Financial Protection Bureau outlines it.
All right, Act 3. Investors, owners, and MERS, the backstage directors.
Now we're going to pull back the curtain to reveal the backstage directors who are pulling the economic strings, even if you never actually speak to them. First up is the investor, or the loan owner. This is the party holding the actual economic interest in your loan. We're talking big entities here, like Fannie Mae, Freddie Mac, or a securitized trust. Now, you might never hear directly from the investor. In fact, the servicer usually just acts as their agent. But don't be fooled, the investor's identity absolutely matters. Their specific guidelines are the ones that dictate your loss mitigation options, your loan modification rules, and who ultimately holds settlement authority.
Okay, let's dive into an acronym that sounds kind of like a weird infectious disease, but actually shows up in countless county land records. MERS, or Mortgage Electronic Registration Systems. Basically, MERS acts as a nominee, or a mortgagee, or beneficiary of record. What that means is it acts in a representative capacity for the lender and its successors. It serves as a sort of public record placeholder for mortgage transfers among its members. Now, understanding this really strikes down those extreme internet rumors that spread like wildfire about MERS. Let's set the record straight. MERS is generally not your original lender, it's not your loan servicer, and it's definitely not the owner of your promissory note.
Seeing MERS on your documents isn't some automatic fraud mechanism that just voids your debt, and it doesn't mean they hold unquestionable power either. MERS operates in a strictly limited representative capacity. Its authority is totally defined by state law and the specific language written right into your security instrument.
On to Act 4, trustees and foreclosure enforcers, the designated actors.
Let's introduce the enforcers of the cast. These are the folks legally designated to step in if things go wrong and a default happens. Now, a vital distinction that trips up a lot of people is the role of the trustee. The trustee named in your deed of trust is what we call a security instrument actor. They hold a power of sale under state law if you default. This is completely different from a private trustee, the kind who administers a family's estate planning. The trustee in your property docs doesn't own your house for their personal benefit. They are strictly bound by the duties outlined in the security instrument and state statutes.
And here's something to watch for. Often, the original trustee named at closing gets replaced before a foreclosure even happens by a substitute trustee. This is typically a law firm or a title company. If a substitute trustee steps in to foreclose, you absolutely must verify if they were properly appointed and whether that substitution was recorded before they took action. It's a critical document and timing issue that has to be proven right there in the public record.
You've also got to keep an eagle eye on assignments. You'll see assignments recorded in public records that transfer claimed interests like a mortgage interest or servicing rights. But here is a massive, massive detail. An assignment of a mortgage is not always a transfer of the underlying promissory note. Their legal effect completely depends on exactly what was assigned, who signed it, the timing, and your specific state's laws. It's never just a simple copy-paste situation.
Which brings us to one of the most critical concepts in all of mortgage law, the person entitled to enforce, or PEET. This is actually a uniform commercial code concept. See, the investor might own the economic value of your loan, but the PEET is the party who holds the actual legal power to enforce the promissory note in a court of law. Ownership and the right to enforce, they are not always the same thing. Separating these roles is absolutely vital if a legal dispute ever pops up. Finally, Act 5. Map your mortgage players. Let's look at a practical framework. Okay, so now we're going to take all this complex legal chaos and give you a highly practical framework. If you've ever stared at that absolute mountain of closing paperwork and just wondered how on earth to make sense of it all, consider this your ultimate cheat sheet. It shows you exactly how to organize your own mortgage packet into a clean, easy-to-read breakdown of actors. When you look at a document, just try to pinpoint the role. Is it the lender extending credit? Is it the servicer managing the account? The investor holding the economic interest? Or maybe an assignee receiving a transferred right? By filling out a chart just like this with your own paperwork, you'll immediately see the boundaries and the actual limits of every single company claiming an interest in your property. It's a real game changer. So, if you take nothing else away from this explainer, remember this golden rule. You must identify the role before making the claim. You literally cannot fight a legal battle, effectively request loss mitigation, or even fundamentally understand your own debt until you accurately identify who is acting on the other side of the table and exactly what legal authority they possess. I want to leave you with a bit of a challenge. Pull out your own mortgage documents tonight. Just grab your latest statement, your deed of trust, your promissory note. Trace the names and ask yourself, who is actually starring in the ensemble cast of your property? Knowing the answer to that question might just be the most empowering real estate discovery you ever make. Thanks so much for joining me on this explainer. And hey, happy investigating.